The United States is the most powerful economic force in the world, with the largest economy, strongest military, and dominance over global financial markets. Its currency drives global trade, and nearly half of the world's stock market value comes from American companies, making its power seem unbreakable. But beneath this strength lies a hidden vulnerability, not in weapons or armies, but in financial markets, government debt, and global trust. And if the system that gives America its power becomes its greatest risk, it could reshape global power in unexpected ways. America as the world's financial center. For nearly a century, the United States has functioned as the financial anchor of the global economy. When governments, banks, or investors want a safe place to store money, they often choose U.S. Treasury bonds, loans made to the American government. These bonds have long been considered the safest investment in the world. Unlike private companies that can collapse or default, the U.S. government has historically been seen as extremely reliable. This reputation is built on political stability, strong institutions, and consistent economic growth. Because of this trust, countries around the world, including Japan, China, and the United Kingdom, hold enormous amounts of U.S. government debt. They lend money to America and receive interest payments in return. Although the returns are relatively small compared to stock market investments, the perceived security makes them attractive. This trust has allowed the United States to borrow massive amounts of money at very low interest rates for decades. But this system depends entirely on one fragile element: global confidence, the scale of America's debt problem. Today, the United States carries approximately $38 trillion in national debt. That equals roughly $110,000 for every American citizen. For most countries, managing such enormous debt would be nearly impossible. However, the U.S. has historically avoided crisis because investors believe its economy is stable and its government will always repay its obligations. This confidence keeps borrowing costs relatively low. However, even with favorable conditions, the cost of maintaining this debt is enormous. The U.S. government already spends around $1 trillion annually just paying interest on its loans, more than its military budget. If interest rates increase even slightly, the cost rises dramatically. A small increase in Treasury yields can add tens of billions of dollars in additional payments each year. The system works only as long as demand for U.S. debt remains strong. How the Treasury market works. Government borrowing operates through supply and demand. The U.S. continuously issues new debt to finance spending, while investors, including foreign governments, buy that debt. For decades, demand has remained strong due to America's reputation for reliability. But if major buyers reduce their purchases or begin selling their holdings, the balance shifts. When demand falls, the U.S. must offer higher interest rates to attract new buyers. Higher rates increase borrowing costs across the entire economy, affecting everything from mortgages to corporate loans. This creates a powerful form of financial pressure. Foreign governments hold significant influence. Roughly a quarter of U.S. government debt is held by foreign investors, primarily in Europe, East Asia, and Canada. These nations collectively control trillions of dollars in American financial assets. If even one major holder, such as Japan or China, aggressively sold its Treasury holdings, the effects could be immediate. Large-scale selling would flood the market with supply, forcing interest rates higher and increasing the U.S. government's financial burden. In recent years, there have already been signs of change. China, once the largest foreign holder of U.S. debt, has reduced its holdings significantly, selling hundreds of billions of dollars in Treasury securities. European financial institutions have also explored reducing exposure to American markets. Individually, these actions may appear small, but collectively, they signal shifting attitudes toward the U.S. financial system. The concept of financial warfare. Some analysts describe this potential leverage as capital warfare, using financial tools rather than military force to influence global power. Instead of deploying troops or weapons, countries could theoretically pressure the United States by reducing demand for its debt or selling existing holdings. This would increase borrowing costs, weaken financial markets, and potentially slow economic growth. In extreme scenarios, a coordinated sell-off of U.S. debt could trigger global financial instability. Such an event would not only affect the American government, but also the broader economy. Rising interest rates would increase the cost of mortgages, credit cards, and business loans. Investment could decline, unemployment could rise, and consumer spending could weaken. Given that U.S. consumer debt has already reached record levels, around $18 trillion, higher interest rates could create severe financial pressure for households. Why this strategy is risky for everyone. Despite its theoretical power, using financial pressure against the United States would come with enormous consequences for the countries attempting it. Most foreign holdings of U.S. debt are owned by private investors, pension funds, and financial institutions. Governments would struggle to coordinate large-scale selling without disrupting their own economies. Furthermore, selling massive quantities of Treasury bonds would force investors to accept heavy losses, as bond prices would fall rapidly during a market sell-off. The global financial system also relies heavily on U.S. Treasuries as collateral. Banks use them as secure assets to support lending and financial transactions. If their value declines significantly, financial institutions worldwide could face liquidity crises, similar to the mechanisms that triggered the 2008 financial crisis. In other words, destabilizing U.S. debt could destabilize the entire global economy. This mutual dependence makes a coordinated financial attack highly unlikely, but the possibility alone represents a strategic vulnerability, America's greatest strength and weakness. The United States occupies a unique position at the center of the global financial system. Its dominance is not enforced by force, but by trust. Countries invest in American debt because they believe in the stability and predictability of its institutions. This trust allows the U.S. to finance large government spending, maintain a powerful military, and run persistent budget deficits. However, trust can erode faster than it can be rebuilt. If global investors begin to question America's economic stability, political direction, or financial reliability, demand for its debt could weaken. Even small shifts in confidence can have large financial consequences. This creates a paradox. The same financial system that gives the United States immense global influence also makes it dependent on international confidence. The rise of alternative financial systems. In response to geopolitical tensions and economic uncertainty, several countries have explored alternatives to the U.S.-centered financial system. European leaders have proposed strengthening the euro as a global reserve currency to reduce dependence on the dollar. Meanwhile, central banks worldwide have increased purchases of gold, viewing it as a stable store of value during uncertain times. Precious metals such as gold, silver, and copper have seen rising demand, reflecting broader concerns about global financial stability. Some analysts interpret this trend as preparation for a more fragmented financial order. Although the U.S. dollar remains dominant, these shifts suggest that the global financial landscape could gradually become more diversified. The global consequences of financial instability. If confidence in U.S. debt were significantly weakened, the consequences would extend far beyond American borders. Higher U.S. interest rates would affect global borrowing costs, international trade, and investment flows. Financial markets around the world would experience increased volatility. Developing economies, which rely heavily on dollar-based financing, could face severe economic stress. Because the global economy is deeply interconnected, instability in the United States would likely trigger a worldwide economic downturn. This interconnectedness acts as both protection and risk, discouraging direct financial confrontation while amplifying potential consequences. The next global conflict may not be fought with weapons, but with money, markets, and trust. If confidence in the U.S. system ever breaks, the impact could shake the entire world. If you want to be smarter every day, like and subscribe.